Hi, good afternoon. It's Brian from Belvoir. I just wanted to give you a quick update on where things are at in the housing market. Clearly, it's been a really busy 24 hours. Yesterday, we had the increase in the base rate, and the Bank of England has increased the base rate by 50 basis points, or 0.5% to 5%. Money markets are currently expecting that interest rates will peak at around 6.1% by the end of the year. And it's important to look at the rate of increase in the rates. Base rates have now risen from 0.1% to 5% in just 17 months. And this is the highest level that we have had rates since September 2008. Today, we've just had an important announcement from the Chancellor of the Exchequer, Jeremy Hunt, where the Chancellor, the FCA, the Financial Conduct Authority, and the banks have agreed a range of measures to help people go through this difficult period where with increasing mortgage rates. So the main thrust of that is that effectively there will be forbearance where there will be no repossessions for a 12-month period, and you can work with your lender to go onto an interest-only period for up to 6 months, and it will not impact on your credit score. So they're very positive measures. Back to the interest rates, obviously it's all been driven by inflation. Inflation has remained stubbornly high at 8.7% now for the last 2 months, and the Chancellor and the Bank of England are pretty much at one, where we need to drive this inflation down. The target rate is 2%. The increase in interest rates does have a higher risk of putting the economy into recession, so we'll have to see how that unfolds. Interestingly, the minutes from the MPC meeting, the Monetary Policy Committee meeting, indicated a 7-2 split. So 7 people in favour of raising the rates by the 50 basis points, and only 2 saying keep it stable. The next meeting is on the 3rd of August, so we'll watch this space to see if there will be a further increase, or feeling it may be 25 basis points. It'll really depend on what happens with inflation. When we look at the impact for mortgage holders, mortgage holders who are not currently on a fixed rate are now paying around £6,000 more annually than they were 2 years ago. There's nearly 1 million borrowers who are on tracker mortgages, so they're linked to the base rate, so they have seen those increases over the last 17 months. There are 800,000 fixed rate mortgages that will expire by the year end. So there'll be 800,000 people coming off a low fixed rate to go on to the higher base rates. A further 1.6 million mortgages or households will have their fixed rate expire in 2024. So there's a lot of people coming into this cycle where they're going to need to look at refixing or going onto a variable rate, and working with the banks to see where that will be. So hopefully as we get into 2024, we'll hopefully see the rates at least stabilising and hopefully starting to come down. House prices. There's a number of different measures. You can look at the land registry. Halifax had the recent house price index out, and broadly the house prices are remaining unchanged, down slightly from May to April, and the average property price per the Halifax index about £286,000, with a 1% year-on-year fall. So there is a slowdown in the market. It's not a price crash, but there is a slowdown, and we expect to see that continue as we go into the summer months. And then we have to see what happens in the autumn as we go into kind of what should be a reasonably busy selling period for sellers. Just to have a quick look at what's happening to asking prices. So if we look at the Rightmove indexes, we've seen that we have the first fall in asking prices since June 2007. Only marginal. It's down £82 on this month, bringing the average asking price to £372,000. Interesting to note that Rightmove still predicts an overall 2% annual drop in new seller average asking prices by the end of 2023. So, we're seeing the market becoming quite stable, becoming quite settled. So what does all this mean, this change mean for sellers? Well, sellers are still active in the market. We're bringing a number of properties to the market, but the sellers need to be realistic. You know, buyers now are seeing their affordability reduce in terms of the amount of income that will be required to meet their mortgage payments. So sellers need to be aware that they need to come to the market at a realistic price, and rather than having 4 or 5 people potentially bidding on the property, there'll probably be 1 or 2, and we need to negotiate with those parties. Buyers, on the other hand, they're actually reassessing what they're going to do. A lot of people who previously may have been looking to move from a 3-bed semi-detached to a 4-bed detached, now they're reappraising and maybe going to a 4-bed semi, or going from a 2-bed rather than to a 4, they may go to a 3. So there's probably an interim step for people now on the property ladder. They're not going to maybe their final home, they're on the trading up, they're going there to something maybe slightly less, and then will maybe move again another 3 or 4 years. The other area is obviously investors. So we are seeing a number of landlords where we classify them as accidental landlords, where they may have inherited a property or to move out of a property, kept it to rent, and bought their current home. We're seeing some of them looking to sell their properties, as both their family home and their investment property mortgage may come to an end of a fixed term. The remortgage cost for both of those is going to be quite high, and some are looking to offload their investment property. We're bringing those to our current investors who are looking to acquire them, because we've seen a huge increase in rental inflation, well over 10% in the markets we operate in. So we're seeing yields on investment properties increase significantly. So for investors who have very low level of debt, or who are cash buyers, it's a great opportunity to secure some good quality properties without the frothing in the market that we would have experienced over the last couple of years. So they don't have to overpay for the asset, but they're getting good quality tenants in situ, and also having good rental growth in the property. So next time the rent review comes through, or if the tenant vacates, they can bring the property to market rent. So that's a quick synopsis, quick fly through of where things are at. If you'd like a more detailed discussion on whether you're buying or selling property, if you're an investor, you're looking to acquire more property, or if you're looking to sell your buy-to-let investment, please do give us a call on Belvoir. Our numbers are below. Thank you.